In this video, we continue our discussion on Chapter 13, in which we go over deposit creation, where in our last video we defined money as well as the money supply, where in today's video we seek to discuss deposit creation by setting up some preliminaries in order to define deposit creation, define T accounts, and then go over an initial example in terms of the loan creation process that banks go through. Where, beginning with our preliminaries, currently we are seeking to develop monetary policy as our second policy tool the government can use to restore a long-run equilibrium given an AD shock. Where, in order to develop monetary policy, we will need money as well as the deposit creation process, the Federal Reserve, as well as the money market and aggregate product market. Where in this chapter we're covering money and deposit creation, where in our last video we went over money. Therefore, in this video and our following video, we'll go over deposit creation, where in regards to our last video, we defined money as anything generally accepted as a medium of exchange, where it also had to fulfill the three roles in terms of being a medium of exchange, a store of value, as well as standard of value. And in terms of defining the overall amount of money in the economy, that is the money supply, we set forth with two definitions, one being the M1 money supply and the second being the M2 money supply, where the M1 money supply is currency held by the public plus balances in transaction accounts, where this was primarily thought of as cash as well as checking accounts balances. Therefore, it was rather liquid or pretty straightforward and easy to use the M1 money supply in terms of going about daily transactions at stores. Whereas the M2 money supply is M1 plus balances in most savings accounts and money market mutual funds. It consists of both cash and checking accounts that comprise M1, but also includes savings accounts and money market mutual funds. Therefore, it's larger than M1, but also with the addition of savings accounts and money market mutual funds, it makes it a little less liquid in that savings accounts and money market mutual funds are not as straightforward as cash and checking account balances in order to use in the marketplace to make transactions with. So then, with our definition of money and the money supply in place, we now seek to use this to examine how money is created. Where in regards to the money creation process, there are two ways that we could consider. The first being printing more cash, and the second is deposit creation, where deposit creation is going to be the creation of transaction deposits by bank lending. But something to keep in mind as we are making this decision on which to look at, in our prior video we saw that cash was about 42% of the M1 money supply and about 10% of the M2 money supply, whereas transaction account balances were about 57% of the M1 money supply and about 15% of the M2 money supply. And lastly, savings account balances were about 68% of the M2 money supply. Thus, given that cash is only a small portion of the money supply, particularly of the M2 money supply, and savings as well as transaction account balances consisting of a large part of the money supply, particularly the M2 money supply, we should focus our attention on our second option in terms of the money creation process, that is deposit creation, where deposit creation is going to focus on the creation of money in transaction account and savings accounts, where the premise of the process is as follows. The first step, we have an agent that deposits cash into a bank, where the bank accepts the cash and gives the agent a balance on an account in the form of their checking accounts or their savings accounts, from which the bank has additional cash on hand from the deposit, where the bank then makes a loan based on a portion of the additional cash on hand, where through this loan a new balance is added onto some other agent's account, where the money supply then increases via the amount of this loan. So then, the amount that the bank can overall loan out will be limited by the Federal Reserve, as mentioned by a portion on additional cash by hand, which is something that we seek to explore later on when we talk about the Federal Reserve. And this will give the Federal Reserve overall control over the money supply. Where in regards to this process that we described in the prior slide, to keep track of this, we will use T accounts, where T accounts are accounting ledgers used by banks to track assets as well as liabilities, where we can define assets as things of value that the bank possesses, such as cash held in reserves, IOUs, which are going to be loan obligations that agents must pay to the bank, as well as bonds that the banks purchase, which are interest-bearing assets, and liabilities to other agents, such as the government who send out the bonds. Next, we have our liabilities, which are going to be things that the bank owes to other agents, and an example of this is going to be agent deposits on their account, in that when an agent deposits their cash and a credit is made to the agent's account, the bank is therefore responsible in terms of paying this agent by that amount. And in addition to this information, in regards to our T accounts, the balances must match in terms of our assets must equal our liabilities. So then, proceeding on to an initial example, given the deposit creation process as well as our definitions in place for a T account, let us consider the world of a consumer, a firm, as well as a sole bank, in which the consumer makes an initial $100 deposit to the bank, where here on the left we have our T account, and we're assuming that the bank is called University Bank. On the left of this 2x2 matrix we have assets, which are going to be things of value to the banks, and on the right we have liabilities, which are obligations that the bank must pay. And on the right we also have our chart to keep track of the size of the money supply. So given through with this process, what we have is the consumer depositing $100 cash to the bank. When this occurs, the consumer drops off the $100 in cash to the bank. This adds $100 cash that the bank now holds, which is an asset to them. So their asset account gets $100 added to it, from which the bank then credits the consumer's checking or savings account by $100 to equal out the amount of cash that they dropped off. This credit placed on the consumer's account must then be paid at some point by the bank. So this is a $100 liability that the bank must pay. So in this transaction that occurred, we have $100 being added in cash to the bank, and they must pay the consumer $100 in terms of the credit added to their account. Where in regards to what's going on with this in terms of the money supply, the consumer drops off $100 cash to the bank. So then this takes away $100 cash from the money supply in the economy, but in exchange for this, they got a $100 credit to their checking or savings account. So then what this does is add $100 in terms of transaction account balances to the money supply in this economy. Since these two changes cancel each other out, minus $100 cash plus $100 in terms of transaction account balances, the overall change in the money supply is zero. Therefore, this deposit of $100 did not change the money supply in terms of its size, but the composition in terms of less cash to more transaction account balances. So then to recap overall, what we have so far in this process is the consumer deposited $100 to the bank, where the bank accepted the $100 cash, adding to their assets, and they also credited $100 to the consumer's account, which added to their liabilities. There was no change in the size of the money supply, just its composition, in that the consumer now has a $100 account balance as opposed to $100 in cash. So now that the bank has $100 in cash that they are holding, they then decide to make a loan to a firm who seeks to start or expand their operation. So what's going on in terms of our T account is, given that the bank now holds $100 cash in terms of their assets, they decide to make a $100 loan to a firm who seeks to start or expand their business. Where when they make this loan of $100, it's a credit placed on that firm's account, which adds to it. and this bank therefore has an obligation that it has to pay to this firm in the form of $100. Therefore, it's a $100 liability placed on that firm's account. Therefore, we see it on the liability side on the right. But at the same time, with this $100 credit placed on the firm's account, this firm now also has to pay the bank back $100. So there is a $100 IOU that is also placed on the bank's asset sheet. Therefore, with this loan, we have $100 being added in terms of assets as well as liabilities. And we have our initial deposit from the consumer and the credit placed on the bank as well. So here we have assets equaling liabilities still as expected. And in terms of the money supply, in this instance, we have no change in terms of what's going on in terms of cash, given that there's been no further deposits or withdrawals in terms of cash. But what happened was the bank credited this firm on their account by $100. So this added $100 in transaction account balances. Therefore, the money supply has grown by $100 in the form of an increase in transaction account balances of $100. So this loan added to the money supply and did not change the composition of the money supply in terms of changing from cash to transaction account balances, as we saw in the deposit portion of this process. So then what we have then to recap is when the bank credits the firm's account of $100, it's a liability that the bank must pay to the firm. In the same instance, the firm now has an IOU that it must pay to the bank of an equal amount of $100, where with that $100 credit placed on the firm's account, the money supply has increased by $100 in account balances. And putting both steps together in terms of the deposit made by the consumer and the loan made by the bank to the firm, we saw that deposits changed the composition of the money supply, not its size. The addition of assets to the bank from the deposit allowed the bank to make the loan in the first place, that is the addition of that $100 to their asset sheet. And the loan made by the bank is what expanded the money supply in that it allowed the firm to have a credit on their account to make future purchases of $100, where in this overall process, the amount of reserves that the bank held did not change. That is, once they got that $100 of cash from the consumers, the amount of cash they were holding did not change, where we will define reserves as assets held by a bank to fulfill its deposit obligations. So, with this simple transaction considered, where we'll proceed in our next video is we will relax some of our assumptions and consider more involved examples in terms of the deposit creation process to see what the limitations of this money creation process are.